Warriors of price action and guardians of fundamentals, welcome to Retail Recon. On today's Gear Up episode, it's all about trigger discipline. We will cover the basics of order execution in the form of market orders, limit orders, and stop orders presented from both the buying and the selling side. So, gear up and let's go to work. Orders are your weapons of choice in how you want to engage the target. Different weapons for different missions. Master these and you control execution. Fumble them and the market controls you. Let's break them down one by one. Market orders are all about speed. They execute immediately at the best available price. Once submitted, you have no control over the exact price at which they will get filled. When you hear the term fill, it means your order has been executed. If you submitted a market order to buy one share, a fill means you bought one share and you are now the owner of that share. Technically, because of settlement cycles, ownership finalizes a bit later, but you can trade the stock immediately after execution. Execution is just another way to describe a fill. Buy market orders get filled at the ask or better. Remember the ask from the option series? That is the sticker price. The best price sellers are currently offering. These orders are best used when you need instant entry. Price is secondary. All you care about is getting into the trade as fast as possible. If you are considering that type of order, make sure the instrument has high liquidity. That lowers the risk of your order getting filled at a very unfavorable price. You can also sell using market orders. If, when buying, you pay the ask, what do you receive when you sell? Exactly, you receive the bid. Your sell market order will get filled at the current bid price or better. On your screen, you will see a current stock price, but that price is always determined by the bid and the ask. The difference between the two is known as the spread. It is useful to check those two numbers before jumping into a trade, as a big spread may indicate your market orders getting filled at unfavorable levels. The biggest risk when using market orders is slippage in low volume or gap situations. Because you have no control over the price, you can expose yourself to big hits. But if speed is your primary focus, you are, or at least should be, prepared to take that risk. Contrary to the market orders, limit orders focus on price control. They are your sniper operations, precise and deliberate. With a buy limit order, you specify in advance the maximum price you're willing to pay for the stock or any other asset. The order will be executed at that price or better. For a buy limit, better means lower than your limit. Important, buy limit orders must be placed below the current market price. Putting it together, the stock is at 50, you place a buy limit at 49.50 and it will only get filled at 49.50 or lower. You can also use limit orders to sell. With sell limit orders, you specify the minimum price at which you are prepared to sell. As with buy limits, the order will get filled at the specified price or better, which in this case means higher. Sell limit orders have to be placed above the current market price. For example, the stock is trading at 50, you place a sell limit at 51 and it will get filled at 51 or higher. In practice, with limit orders you are usually buying support and selling resistance. If you are unsure what that means, don't worry. Those concepts will be explained in detail in one of the future episodes. Compared to market orders, where speed is the main priority, limit orders are your mechanism of control. All you care about is price. You have a predetermined level at which you want to buy or sell. On the sell side, they are also commonly used to lock in profits. Your biggest risk with limit orders is that they do not get filled. The price never reaches your designated level. What often happens then, it happened to me as well in the early stages, is traders start to chase the price by adjusting their orders. If you catch yourself doing that, stop for a second and regroup. Consider whether your setup is still valid after your entry or exit point has moved. If the thesis is unchanged, by all means, go after it. But make sure you are following your rules of engagement, not your fear of missing out. I like to see stop orders as landmines. They are practically invisible, you forget they are there, but once they are triggered, everything goes off. Stop orders are instructions that turn into market orders once the specified price is reached. Buy stop orders turn into buy market orders and sell stop orders turn into sell market orders. That means you specify the trigger level, but you do not control the exact execution price. Contrary to limit orders, buy stops must be placed above the current market price and sell stops must be placed below the current market price. Example, stock price is at 50, a buy stop at 51 means once 51 is reached, a buy market order will be executed at then current price. This is also where the biggest risk of stop order lies. Big gaps and slippage. Imagine a scenario where you place a sell stop at 50 and the stock gaps down to 25 overnight. That would trigger the stop and sell market order would execute near 25, far below your intended level. In general, the biggest advantage of stop orders is automating entries and exits. Basic use cases: sell stop orders for protection, stop losses, buy stop orders for momentum, breakouts. For example, if you expect a stock on your watch list to break out and you do not want to miss it, you place a buy stop at the level where you expect the price to break. Just like the gap down example, your biggest risk is a violent move where you might end up buying at a very unfavorable price. That is your basic stop order in a nutshell. There are also variations, such as stop limit orders, but for now the focus is on the basics. Important to note, while all brokers offer the three basic order types we discussed here, there can be big differences with more advanced types. For example, personally, I like to use trailing stops a lot, and there are not many brokers, at least not in Europe, that offer trailing stops on US stocks. Next, let's touch on combining different types of orders. These are often referred to as bracket orders. Think of them as your full fire mission, a complete package. Before we continue, keep in mind, not all brokers offer bracket orders. You can potentially input every order manually, but the problem is you usually cannot place a sell stop and a sell limit against the same shares at the same time. Bracket orders work in a if this, then that way. If target is hit, take profit. If stop is hit, cut loss. Once one executes, the other is cancelled. Manual single orders are not like that. They are simple: if this happens, do that, and they lock the shares. For example, if you place a sell stop for 10 shares, those 10 shares are locked. The only way to unlock them is if the order gets cancelled or executed. You cannot simultaneously place a sell limit on those same 10 shares. So if you like, or would like to use, bracket orders, make sure your broker offers that functionality before opening an account. Back to our bracket orders. A typical bracket will be structured around three objectives: entry, protection, and profit. One way of executing this mission plan would be enter the trade with a buy market or buy limit order, protect your downside with a sell stop order, and secure a potential profit with a sell limit order. This is a complete set it and forget it approach which takes emotion out of the equation. Pure execution. You now understand the basics of order types: market for speed, limit for price, stop for protection, and bracket for automation. If you found value in this mission, lock in your support by liking, subscribing, and following our movement. Thanks for standing watch with me today, and until next time, trade smart, risk sharp, and stay on target.